Can someone confirm the same?
Yeah, I confirm audio is clear and the screen is visible.
Okay, having confirmed the same, let us proceed with the contents for the day. Uh, these live sessions, as I've been always telling you, they are basically for revision purposes. They do not substitute the lectures that you must watch on the LMS. You'll find that I will not cover everything in the standard that I covered already in the video on the LMS. I'll only pick out the key points. That's what we shall discuss, and then we proceed to the practice session. Therefore, make sure that you've watched all the videos on the LMS so that when you come here, it's just a matter of following through and then clearing your doubts. So, having covered the standard, can someone give us a brief of what they remember from that standard? Any discussion from anyone? Ivan, do you remember anything?
Yes, I remember few things on this standard.
Mm.
One, like fair value, uh, is that price that one would obtain when they sell an asset or settle a liability in an ordinary course of business. Then also about this standard, there are different ways of how we measure fair value depending on the situations on ground.
Okay.
Uh, yeah, also maybe the basis of how to determine fair value on how to get this. Is it using the maybe the active market? Is it using the yeah? That's something I remember about this standard. Yeah, maybe I will get more detail when you're trying to.
Okay. So at least remember the definition. That is important. You also remember the fact that we have different levels: level 1, level 2, and level 3. That is also very important. Okay, people here. Okay. So anyone else to share what they remember or what they can discuss about the standard? We've heard from Daniel the definition and then the levels when it comes to input for fair value measurement. So anyone else to share something? Yes, please. Meanwhile, whatever you cover can be examined. In fact, that's why I even shared the syllabus with you guys so that you can pay attention to everything that you are studying. We do not have any irrelevant information. Okay, I'll proceed and give a brief about the
I
standard.
also remember something.
Yes, Gades.
We also talked about markets where there is a principal market and the most advantageous market, where a principal market is one with the greatest activity, and advantageous market is where the highest amount is offered or received. But a principal market is taken into consideration most, then an advantageous market can be thought of as second priority.
Okay, that is very, very important. That is very, very important. The principal market versus the most advantageous market. Okay, someone saying failing to join. So can you first add this person? Okay, yes, that is good, Gladys. It is a plus. Anyone else with anything they can share with us from the standard? Richard Abaho, did you cover the standard?
Yes. Am I audible?
Yes, please, you are.
About IFRS, the parties involved in they must know about the market conditions, the location of the asset of which the and restrictions. Like both parties should know about majorly those.
Okay. You are talking about what we call ordinary, or what you say orderly transactions. And I have to share links, then have to allow in people. Okay. All right. So it was Richard. He has shared about dealing with orderly transactions where the market participants should have enough information so that we do not have what we call biased transactions. He went ahead to discuss what we should know, like the asset condition and location, though he forgot something like any restriction to use, right? So those are the key points that we can talk about. Okay, and trust me, dear students, if you have this knowledge, then you read the question, you can be able to cite out those points. Meanwhile, let me give a brief review through the standard before discussing any question that I've prepared for you. Of course, it was Ivan. Oh my God. I think I'm going to be sharing this link 10 minutes to class. Ivan, want it to work?
Yeah, it will.
I think I should be sharing it early so that people can join in and we do not miss out on the minutes when the class has started. Okay, so it was Ivan who gave us the definition of fair value, and in fact this is provided by the standard itself, IFRS 13. It defines fair value as it defines fair value as a price that any market participant would receive if you are to sell an asset, or you would pay to transfer a liability. That is very important. Let me get that definition. Okay, it defines it as a price that you would receive if you are to sell if you are to sell an asset, or if you are to transfer a liability in an orderly transaction. And this is always at the measurement date. The definition of fair value is very important when it comes to IFRS 13. It is very, very important. And as we've already seen, this standard provides us guidance with the definition of fair value. That's why it is very important for you to know the definition. It also guides us on how we should measure fair value. You forgot that fair value is never an entity specific, but rather depends on the market when it comes to non-monetary assets. That is very important. In fact, under this framework for measurement, is where we talk about the levels. The level 1, the level 2, and level 3. As well as also guiding us on the disclosures that we should make in regards to the transactions that involves measurement of fair value. Remember, fair value is more of a management judgment. It depends on the interpretation of management to attach a value on a given transaction. That's why the standard emphasizes most of the disclosures that we should make, so that those who are going to use the financial statements are aware of what you considered when you are making a decision to attach a given fair value on your assets. What we should know is, where this standard guides us on the measurement of fair value, there are some assets where we cannot use this standard because the respective standards provide the mechanism of measuring the fair value. If I can ask Ivan, can you hear me, Ivan?
Yes, I can hear you.
You've had, I think you've covered most of the standards. Which one are you covering now?
I'm now starting on related party.
Related party, meaning that you've covered IS 36.
Yes.
Do we talk about fair value anywhere under IS 36?
Yes.
Do you talk about value in use?
Yes.
You covered IS2.
Inventory, yes.
Which statement relates to fair value in IS2?
Statement that relates to fair value in IS2.
Okay, how do we measure inventory?
We measure, first of all, we measure it at cost. Then we also measure at lower of cost and net realizable value.
Perfect.
That is subsequently, yeah.
Perfect. So NRV is what we can obtain, right? The fair value less cost to sell, right? What we can,
that is true.
What we can obtain from the market, right? Okay.
True.
Have you covered IFRS 2?
Yes. I think that is share-based payment.
Perfect. Do you talk about the fair value of the equity instruments?
Yes, that is, yeah.
Now you see all those standards are talking about fair value, right? But the standard says those respective standards provide the guidance on how to measure the fair value of those assets, right?
True.
Meaning that IFRS 13 does not apply on all those standards I've told you. You do never talk about using IFRS 13 to determine the net realizable value of inventory. Are you getting me, Ivan?
Yes, I'm getting you.
That would be very wrong. So let me share with you those standards where we do not apply IFRS 13. And basically the reason is the respective standards provide a mechanism on how we can determine those specific prices. Okay, let me share it here. Okay. So we can say, okay, it does not apply to transactions dealt with by, someone wants to join, I know. Let me help them in. Okay. So, Ivan, we've talked about all these standards, right? And those of you who are on track, you've covered all these standards. And so when I talk about share-based payments, equity, transactions, you know that we talk about fair value. But that is guided by IFRS 2. So we cannot talk about IFRS 13 when looking at the fair value of the equity instruments. Similarly, when it comes to leases, okay, we also talk about the present value of the future payments when we are determining the lease liability and also the right of use asset. So we also don't talk about IFRS 13. But there are some situations also where we talk about something almost related to fair value, like under IS2, net realizable value, where Ivan told us that we measure inventory at lower of cost and NRV. So this NRV, we do not use the 3 levels of IFRS 13. And the reason is IS2 has given us guidance on how we should measure the net realizable value. So in your explanations, if you're talking about IS2 and you bring in IFRS 13, that will be wrong. Ivan, are you getting my point?
Yes, it is clear.
Same also for IS 36, impairment of assets. We always, Ivan, can you remind me, when do we bring in value in use in IS 36?
Value in use when we're trying to, value in use, that is when we are getting the fair value.
What we call the recoverable amount, right?
Yes.
Which is the higher of fair value, less cost to sell, and the value in use, not so?
Yes.
So this value in use, we do not talk about IFRS 13. And the reason is we always discount the future cash flows. Is that true, Ivan?
Yeah, that's true.
So in a nutshell, we only apply IFRS 13 for only those standards where we need fair value and IFRS 13 does not prohibit us. We shall look at all other standards where we need to get the fair value of assets. Now, like the revaluation model of IS 16, where you need to know the fair value of, let me say, land. There you can apply your IFRS 13 very well. So, it is important for us to know the definition of fair value and also for us to keep aside those standards where you cannot apply IFRS 13. So that when you meet them, you cannot talk about fair value as per IFRS 13 when you are discussing your views. Okay, so after looking at what is prohibited, the definition of fair value, I believe we can move on now and look at a very important statement where fair value is assumed to be a market-dependent aspect rather than an entity specific. That's why we always take the fair value or the price that the market participants would be willing to offer, not what the entity would wish to give or what the entity would wish to receive. That is a very important statement, because in most of your questions, you'll find it embedded there. The examiner will try to show that an entity wants to influence the fair value that they can receive for their asset by putting into consideration what they feel is the use of the asset and the worth of the asset. Okay? So, for you, knowing this is very important, so that when you read a question and you find that the entity wants to dominate the fair value by considering the use they think it is okay or the value they think it is worth their asset, then you challenge it. That's why we are saying that always fair value is focused on the assumption of the market. Whatever the market participants are willing to offer, or whatever the market participants are willing to use the asset, is what should be attached to your asset, but not what the entity thinks the asset should be used for. So, while you are assessing the fair value of your asset, make sure that you use the same assumptions that the market participants are using. And make sure that the characteristics of your asset or their liability are similar to those that the market participants attach on that asset. That's why I think it was Ivan who told us that we should consider the condition. I think it was Richard. The condition, location, restriction to use. So while we are trying to assess the fair value of our asset, let us look at what is the current condition. What is the current condition of that asset? And what is the location? Assuming that you want to attach fair value to your land, you can't compare land in Mbarara to land in Kampala in terms of value, because land always depends on location. You can also not compare land in Mbarara town to land in Kashali. Okay? You can't compare land in a swamp and land on a hill. So the condition and location of the asset is very important. If it is a vehicle, look at those. But also, are there any government restrictions? If you read a scenario and they are saying that the government has passed a law that prohibits residential use of land in this area, that means that even if you want to use the land for residential purposes, the law is already there. There is a restriction on the use of that asset. As such, you cannot attach your value basing on that use that is prohibited by the law. Okay. Let me first attempt someone. Okay. So that is very important. Assessing the condition, location, and restriction on use of the asset. But as I told you, yes, we have this information, but can we be able to apply it in the scenarios. We shall look at a question and see how we can apply. Okay, so let me give you more scenarios where we feel you should know before going in for the paper. When it comes to attaching prices on the asset, an entity cannot claim that, you know what, you are giving me less price compared to the value I am personally attaching to my land. This is very important. Ivan, can you hear me?
Yes, I can hear you.
If you have a phone, please screenshot this, because it's just a small statement, but you're going to find it in the questions that the examiner set. Because the IFRS 13 says an entity cannot argue that the prices are too low relative to its own valuation of the asset. The reason is IFRS 13 says consider market participants. And it can also not say, you're giving me less and therefore I'm not going to sell at these low prices. An entity has no power. Yes, we have what we call management judgment in the application of the standard, but it stands clear that whatever you are deciding on, make sure that you're putting into consideration the market perspective. And so, do not be egocentric to consider what you feel should be attached to your asset. Hannah, is that clear? Okay. We are also saying that when it comes to, remember in the definition we said, it is a price in an orderly transaction. It is a price we either receive or pay when selling an asset or settling our liability in an orderly transaction. So we only consider prices where there is no influence, because the standard defines an orderly transaction as one where there is exposure to the market for a period before the date of measurement to allow for normal marketing activities to take place and to ensure that it is not a forced transaction. In brief, we want to see a non-forced transaction. And we want to see the asset being within that market, interacting with the market participants for a given period of time before you decide to sell. You cannot sell an asset where you do not transact. That is the implication of this statement. You should sell where you often transact, so that you have enough information regarding your asset, regarding the perspective of other market participants. And that is what the standard requires us to always look at. Okay? The challenge is IFRS 13 does not specifically provide what we call a unit of account. Let me get this here. Okay. So we are saying that the standard does not specify which asset or which liability or a group of the same should be used to measure fair value. That one is not provided. So what happens? Management has the chance to ascertain or to assess which unit of account to measure their fair value measurement. This one here subjects the financial statements to biasness. And you find that maybe question 4 of your paper can ask you about investor interest, where IFRS 13 has been used. What do you think the investor will be interested in knowing? And what is the impact of management biasness when determining fair value? You will find that maybe these guys are trying to create a huge asset base. So they change from cost model to fair value, and then they skyrocket the value of their land. And they even ignore the guidance of the experts, the valuation experts. Ivan, are you getting the argument?
Yes, I'm getting it.
While the
Pardon on that, I've not gotten it well.
While the standard provides management with an opportunity, okay, to make judgment in fair value measurement, management is likely to misuse that opportunity. And therefore, assuming that these guys, let me say an entity, has a loan in a bank, and this loan has a covenant, and the covenant is attached to probably the assets or the asset value of the entity. So the finance director looks around, realizes that they can use fair value measurement to inflate the value of land. So they and then change their policy from cost to fair value. And then they increase the value of land so that they can remain within the loan covenant. Are you seeing how management is manipulating the financial statements? Have you got it now?
Yes, it's okay.
So that's how the examiner is going to establish the scenarios. And you see that these guys are trying to manipulate the statements when they ignore the guidance of the technical valuers. They say, you guys, for us, we feel our land should be valued at this much. They go ahead and put it in their financial statements. So it is about you to come and say, we always look at market participants, not entity specific. Therefore, you considering your own use of value is against the requirements of IFRS 13. So that's the level of interact and the level of interaction with the scenario that you should exhibit when approaching these questions. Okay. We can proceed now to our next part. And this one, I want us to discuss, someone talked about the principal market and then the most advantageous market. Okay? So, IFRS 13 says, the transaction to sell an asset or transfer a liability is often in a principal market or in a most advantageous market. I'm sure the standard or the video lecture discussed much about this and even how we determine the principal market and the most advantageous market. So you either have the principal market, and this is the market where you have the greatest volume and the level of activity is very high. If you have two markets, one in Imbuya, another one in Karwere, both of them are abattoirs. So you can take there your bull and then you get money. But one has more transactions in a day. Let me say 1 million bulls are purchased or are sold and bought in Karwere, and only 10,000 are transacted in Mbuya, then Karere becomes the principal market. So, in situations where you have no principal market, where you have no greatest volume, then we look at what we call the most advantageous market. And with the most advantageous market, here we look at a market that gives us the highest value for our asset. So this defines what we call the principal market. I've already defined this for you. A market with the greatest volume. Very important. So whoever gave us that hint, please, you're on the right track. Those are the key points that you should look out for in IFRS 13. A market with the greatest volumes. And if we do not have such market, then we look for the most advantageous. And we've said that the most advantageous one is one that gives us the highest value for our asset. That's why the standard defines it as a market which maximizes the amount that would be received for the asset or paid to extinguish the liability after considering the transport cost and the transaction costs. Ivan.
Hello?
Ivan.
Yes.
After, let me first do something here, otherwise. Okay. We are saying that for us to identify the most advantageous market, we look at the market that gives us the highest value. What we call the market that gives you the highest take home. And the highest take home is the selling price, remove the transport costs, remove the transaction costs. If it is transferring the bulls, assuming that Mbuya has 10,000 bulls transacted, Karere has 10,000, or just a small margin. Now you do not have there a principal market. You cannot say, let me rush to Mbuya to sell my bulls because there I'll get many buyers. No. They have almost the same volume. Now we look at how much you need to transport your bulls to Mbuya. How much do you need to transport them to Karere? And do you need some commission to have someone connect you to the buyers? Now these are the transaction costs, right? So if you want to know the most advantageous market, look at the selling price, factor in the transport and the transaction costs. Whatever remains is what belongs to you. So you have the highest take home. That becomes the most advantageous market. Now the question is, after identifying the most advantageous market, okay, after identifying the most advantageous market, how do we obtain the fair value of the bulls? Which cost do we put into consideration? Transaction costs or transport costs? Ivan? Ivan, can you hear me?
I can hear you, but I'm not sure on that.
You forgot to get that concept. Okay. Anyone else who can remember? We've seen the principal market is clear. The most advantageous market we can easily get. But after identifying the most advantageous market, how do we attach a fair value now in that most advantageous market?
I remember, like, when you are arriving at the fair value, the transport costs are ignored or excluded. So you'll get your price, then you less the transport cost to come at the fair value, I think.
You've confused me. Which ones do we know? Do we ignore?
The transport costs.
And then which one do we subtract?
Transport, we deduct the transport costs. Then we come to the fair value.
Perfect. Well said now. We do not consider transaction costs. Okay? We do not consider transaction costs when we want to get the fair value. So, for us to identify the most advantageous market, we got our selling price, removed transport cost, removed transaction costs. The one that gives us the highest value is the most advantageous. Now we need to attach a fair value to the asset, to the bull. There we look at now the selling price. We remove the transport costs. That is very important. And in fact, in one of the assignments that is in on the LMS, that question requires this knowledge. Ivan, did you try out that question?
Yeah, I now get it.
Okay. Yes, but the truth is I'm going to mark all your work. So you don't worry. I will sit one day, mark standard by standard, then I give you feedback. So don't worry about it. Even in our revision sessions, you can even ask me questions. I can be able to answer some of your doubts in those assignments. So, we are saying that although the transaction costs are taken into account when identifying most advantageous market, please, this is very important. Especially in case in your paper, you land on a calculation of most advantageous markets, then this is very important. Yes, we subtract the transaction costs on the selling price when identifying the most advantageous market, but when it comes to getting the fair value of the asset in that market, the fair value of the bull, now we do not make adjustments for transaction costs. And the reason is very simple. Transaction costs are characteristics of the transaction. Okay? Because you want to sell, then you incur those costs. But they are not attributed to the bull that you're going to sell. That's why we do not adjust such transactional costs. As you can realize, your paper is less of number crunching, more of technical application of the standard. So you might be lucky to get a question, a calculation question, like the one that I gave you in the assignment, or you'll find only theoretical questions where you have to apply this knowledge and you have to discuss about it. You'll find that maybe someone wants to under declare their sales, or they want to under declare the fair value of their assets with one reason or the other. So they go ahead and subtract the transactional costs when obtaining the fair value of their asset in the most advantageous market. Or it can be that they do not know what should be done. And you can find this under question 2 ethics, where someone has to go and attend some training for them to know the requirements of the standard. Okay. So, any question? Dear students, is there any question regarding what we've discussed, or we move forward? Can we move forward? I want us to try a question, so we should be able to finish this very fast. Ivan, any question?
Not really, but just my question is now, how does we have looked at the principal market, we have also looked at the most advantageous market. Now, I've also had cases of an active market. Now, how does an active market come in here?
We are going to discuss that under the levels, right?
Okay.
Under the levels, But of course, you're going to find that when it comes to the principal market, okay, this is likely to come in. An active market is where you have many transactions, right?
Yes.
So I'm going to discuss that, and in fact, it's one of my it's my next discussion. Okay.
Okay.
So we are saying that why we include transport costs and ignore transaction costs when obtaining the fair value of the asset in the most advantageous market is always location is very critical when it comes to the fair value of the asset. Location is important, whereas transaction costs are not part of the asset. That's why we are saying that we should always adjust the transport costs when obtaining the fair value. And the reason is we always factor in location of the asset, this one here, when assessing and ascertaining the value of the asset. That's why we should always subtract the transport costs. Now, we also talked about having an orderly transaction where market participants have enough information, they are not forced. That's why the standard clearly tells us that always these market participants that we talked about in the definition of fair value should be independent of the other. Like no one should influence the other to sell or to buy the asset. Otherwise, that's why when it comes to IAS 24, there is what we call arm's length transactions. That if I'm selling to Ivan, I shouldn't be forced to sell to him, and I shouldn't ignore the market conditions because I know him. Let me give him this asset at a lower value. No. So the market participants should not be influenced by each other, and they should have enough information regarding the transactions. That's why they should be knowledgeable. And they should be able to consent and enter into transactions. That is basically trying to show us that this should be orderly transaction where the market participants are knowledgeable, they are not influenced, and they are not forced to make the transactions. Then someone talked about the three levels. Yes, IFRS 13 gives us the guidance on what fair value is. Fair value being market-led, not entity-specific. Then it talks about principal markets and most advantageous markets. It further now gives us guidance on the hierarchy. You know, you can have some transactions where there is active market, just the way Ivan was asking. Okay? That is, there are those that are, we have what to call the observable inputs and then the unobservable inputs. When it comes to observable inputs, these ones are happening in the market. Okay? That's why we look at level 1, where we have an active market. Okay? That is, we have a price attached to the value, attached to the asset, and that asset is actively transacted within that market. That becomes now the level 1 input, where we have the asset, we know its price, and it is actively traded in that market. Okay, someone wants to join us. All right. So we are saying the standard provides us the 3 measurement levels, and these ones are based on the inputs. And the standard says when you are attaching fair value on the asset, always consider observable inputs. And observable inputs are, you have your asset traded on the market, the price is known. Now, like for shares, you know that there are volumes of transactions daily in the shares of MTN. Many market participants, the price is known. You do not have to add just the value of MTN shares because the price is already known. That is an observable input. But there are situations where you cannot find such inputs, and you have to look at the cash flows, the future cash flows, then you discount them for you to get the value in use. Then that is not an observable input. It is rather an unobservable input. So we should always look at, or we should give priority to observable inputs, and always don't consider the unobservable inputs. But since this is a hierarchy, then in situations where we do not have the observable inputs, where we do not have the active market, now like if you want to value MTN shares, you have them on the stock exchange. Okay? But assuming that you want to value Airtel shares, they are not on the stock exchange, but you have MTN. Those are similar, not identical. That's when our level 2 comes in. We can go through them very well. When it comes to level 1, these ones are called unadjusted quoted prices in active markets. And I told you that an active market is one where we have transactions of that asset frequently occurring and in very huge volumes. You find that active markets are always for identical assets. If it is MTN shares, you want to probably you bought your shares in MTN, so you want to value them. So you go to the market stock exchange, look for the value of MTN shares. Those are identical. Okay? And always the best example for active market is always shares on the stock exchange. That one you should know. But there is a condition. For you to make use of the prices on the active market, you should be able to access the market at the measurement date. You should be willing to transact. You should have access to the market that you want to consider in valuing your asset. So, Ivan, here's the definition of an active market, where we have voluminous transactions, frequent transactions, and you have the information available. Ivan, is that okay now?
Yes, that is okay.
Well, I think you asked me this question, right?
Yes, it was me.
Okay. So an active market is one where there is frequent transactions in huge volumes, and the information regarding the prices of the asset is purely available. That's why we said we are dealing with knowledgeable market participants. Okay. I'll skip some of these. You can read through in your free time. I know literature is too much. And what is important is for us to see how we can apply the knowledge we learned in the standard. What I can say is, if you do not have an active market, where you cannot find a market where your bulls are sold, identical bulls, then we look at the second level. And when it comes to level 2, here we make some adjustments. Okay? You might find that there are, you might find that there are prices on the market, but not identical to your asset. Probably you have interest rates. You need to attach them to your bonds, but you do not have similar bonds on them. You do not have identical bonds on the market. What you have are just similar, and therefore you need to adjust. Okay, assuming that you want to attach interest rates to your bonds, but because of the nature of industry, you do not have identical bonds on the exchange market. So you have to make some adjustments so that you can reach, okay, to the value of your asset. At that point, you have moved from an active market for the identical asset to an active market of similar assets where you have to adjust the price of the similar asset so that now you can reach on the value of your asset. Okay? That's what the standard is saying. The determination of whether a fair value measurement is based on level 2 or level 3 depends on 1. Are the inputs observable or unobservable? And what is the significance? You'll find that you can have observable inputs, but not for an identical asset. That's why the standard is saying level 2 inputs are inputs other than the quoted prices determined in level 1 that are directly or indirectly observable for the asset. While in level 1 we said we are looking at a fair value of identical assets, in level 2 we only have similar assets. And the information can be active prices on the market, but not for the same asset. So, since it is just a similar asset, then you go ahead and call that level 2. And the reason is you have to make some adjustments on the price of the similar asset for you to be able to reach on the value of your asset. So, they are likely to be quoted assets or liabilities for similar, this is very important, for similar items in active markets. Ivan, is that clear?
Yes, that is clear.
Level 1 quoted, level 2 quoted. The difference is level 1 identical, level 2 similar. And therefore, since it is similar, we must make some adjustments. Now, since we said level 2 and level 3 are somehow confusing, where we look at observable or unobservable, and then the significance. If your adjustments in the price of the similar item is significant, then we are going to take that not level 2, but rather level 3. You have quoted price of a similar item, but for you to reach on the price of your asset, you need to make significant adjustments on the price of that similar asset. Then that becomes a level 3. But if the adjustments are minor, then that is level 2. And now finally, for level 3 for it, it is always unobservable inputs. We've only seen this condition of significant adjustment turning level 2 to level 3. Okay? But level 3 is purely for inputs that are not observable. And I gave you an example. Here we include what we call valuation techniques, like the discounting of future cash flows, so that you can obtain the value in use of the asset. Okay, but since this is a hierarchy, you should always consider level 1. If you don't have level 1 identical, look for level 2 similar. If you cannot obtain similar to make adjustments, then go for level 3. That's why we are saying these inputs for level 3 should only be used when it is not possible for you to access level 1 and level 2 inputs. Ivan, is that okay?
Yes, that is okay.
And this is emphasizing the same. Better we practice questions so that we can see how we can apply level 1, level 2, and level 3. Okay. Okay, I think this is more of a theory we can read through. Okay, let me discuss this. But let me not look at this intentionally so that we can have enough time. Okay, let me remove up to here. Okay, let me discuss about non-financial assets. We have what we call non-financial assets, like land, buildings. We always consider the highest and best use of the asset. Please note that once you want to attach value on assets that are not monetary in nature, you can either say non-financial or non-monetary assets. We always look at the highest and best use. I explained it when I gave the example of you having your land, other market participants are taking it to be agricultural land, but for you, you want to use it as residential land. Then you want to attach value on that land basing on residential use. That is not appropriate. The standard says, always look at the highest and best use. If other market participants are saying, for us to obtain enough returns from this land, we should use it for agricultural purposes, then for you cannot value it using residential purpose. That's why we are saying that it is always determined based on the highest and best use of the asset. And this is always determined by the market participants. And when it comes to highest and best use, we are trying to assess how are the market participants going to use the asset to maximize the benefit of that asset. That is what it means. Highest and best use looks at how the market participants would use the asset to maximize its benefit. If for them they are saying it is residential, that's how we can get the highest returns from this land, then for you cannot take it to be agricultural. Aine, is that okay, Precious?
Yeah, it's okay.
Okay. Okay, so we can, these ones you can just read through. Then when it comes to the disclosures, the standard says we should always disclose information regarding if you have different assets. Some you use level 1, whereas others you used level 2. Give us a breakdown. Okay? That I used level 1 for these assets, I used level 2 for these assets. And in situations where you have measurement of the asset from level 1 to level 2, then also provide a breakdown. That before I was measuring this asset using level 1 because we had quoted prices of the same asset, but now we do not have an identical asset, but they are similar assets. And so we had to make some adjustments. Those are some of the disclosures that you should be able to make. Okay, having ran through the standard, just to refresh our minds, I want us to discuss now a question. And this question is on the practice platform. So those who are on the laptop, you can log into your MySCCA, then access the test reach so that we can start off with our discussion on the question I've prepared. But before proceeding, can I ask, is there anyone with any doubt, or I just go straight to the question? Ivan, can you represent your team? Any question?
For me, no question. No question. There is